On February 4th, 2026, at 11:47 a.m. Eastern Time, Vice President J.D. Vance stood in front of cameras and confirmed something that should have been impossible. The United States government announced it will establish price floors for critical minerals, including silver. If you own physical silver right now, what I'm about to show you in the next 14 minutes will change everything you thought you knew about this market. Because this wasn't a random policy announcement, this was the final piece of a strategy that's been 18 months in the making. I know what you're thinking right now. You saw silver crash from $121 to $75 in 6 hours on January 30th. You watched your portfolio get cut in half while everyone told you it was over. Maybe you panic sold at the bottom, or maybe you're still holding, wondering if you made the biggest mistake of your life. Here's what they didn't tell you. The crash wasn't the end, it was the setup. While retail investors were selling in fear, someone was accumulating. And now, 72 hours after Vance's announcement, the data is starting to leak out. The people who engineered the crash are the same ones who just announced government price support. In this video, I'm going to walk you through a timeline that nobody else is connecting. First, I'll show you what Trump's $12 billion Project Vault actually is and why silver is the hidden centerpiece. Then, I'll expose the leaked timeline, showing how Vance's price floor policy was coordinated with the January crash. Third, I'll reveal the math. If the government sets a price floor at $80 or $100, what happens to physical premiums and paper shorts? Let me take you back to February 2nd, 2026. President Trump stands at a podium and announces Project Vault, a $12 billion strategic mineral stockpile designed to counter China's dominance. Bloomberg, Reuters, The Guardian, every major outlet covered it. But here's what they buried in paragraph 7. The stockpile includes copper, lithium, rare earths, and unspecified precious and industrial metals. Silver wasn't named directly, but if you read the Department of Energy memo released the same day, silver appears 14 times. The memo explicitly states that silver is critical for defense manufacturing, renewable energy infrastructure, and domestic electronic supply chains. That's government language for we need a lot of it, and we need it now, and they need it cheap. Now, 48 hours later, February 4th, Vice President Vance confirms the price floor system. He says, and I quote, "The United States will not allow critical minerals to trade below production cost. We will establish a floor price mechanism to protect domestic producers and ensure supply security." Vance didn't mention a specific number, but Reuters cited unnamed officials suggesting floors between $80 and $100 per ounce for silver. Let's connect the dots. On January 30th, silver crashed 40% in 6 hours, from $121 to $75. The CME raised margins 4 times in 6 weeks. COMEX reported 531 tons of paper silver traded in Shanghai with 0 physical delivery. Everyone called it a bubble bursting. But now look at what happened immediately after. February 1st, CME raises margins again, the 5th time in 7 weeks. February 2nd, Trump announces Project Vault. February 4th, Vance announces price floors. That's 3 coordinated moves in 4 days. If you wanted to accumulate physical silver at the lowest possible price before announcing a government stockpile and price support, this is exactly how you do it. Crash the paper price, trigger margin calls, shake out retail, then lock in policy support at $80 or $100. Let me say that again. If the government is about to buy billions of dollars of silver for a strategic stockpile and they announce a price floor to protect domestic producers, they just created a one-way bet for anyone holding physical. The crash wasn't market failure, it was market engineering. The January 30th crash was the setup for the February 4th policy announcement. Now, here's where it gets insane. As of February 4th, 2026, the paper price of silver on COMEX is $87 per ounce. That's the official price. But go to any dealer right now, APMEX, SD Bullion, JM Bullion, and try to buy physical silver. You're paying $95 to $105 per ounce. That's an $8 to $18 premium over spot. In India, dealers are charging $110. In Tokyo, $112. So let me ask you this. If silver is officially $87, why is no one selling it at that price? Because there's no physical silver available at $87. The paper market says one thing, but the real world says another. And now, the U.S. government just announced they're going to buy massive quantities for a strategic stockpile and set a price floor at $80 or $100. Let's do the math. If the floor is set at $90 and premiums are already $15, that puts real-world physical silver at $105. If the government buys aggressively for Project Vault and global demand continues, premiums could spike to $30, $40 over spot, just like we saw in 1980 and 2011. That would put physical silver at $120 to $130, even if the paper price is capped at $90. And if the paper market breaks, if COMEX fails to deliver physical and the disconnect becomes undeniable, the paper price will have to catch up to the physical. That's when $200 becomes realistic. The government just guaranteed the downside at $80, $100, but there's no cap on the upside. That's the trap. Now, let's talk about the shorts. According to the latest CFTC bank participation report, commercial banks held a net short position of approximately 180 million ounces of silver as of January 28, 2026, 2 days before the crash. When silver crashed from $121 to $75, those shorts made a fortune. But here's the problem. They didn't close those positions. COMEX data shows open interest remained elevated through February 1st. That means many shorts are still in. Now, imagine you're short 50 million ounces of silver at $75, expecting it to fall further. Then, on February 4th, the Vice President of the United States announces a price floor at $80 or $100. You're not just wrong, you're trapped. If the government enforces that floor, your downside is capped and your losses are unlimited if physical premiums blow out. The only way to close your position is to buy silver, and if everyone tries to cover it once, that's called a short squeeze. Here's the timeline that leaked. According to sources close to the Treasury Department, reported by Bloomberg and Reuters but not emphasized, the price floor mechanism will be implemented through a combination of tariffs, stockpile purchases, and direct subsidies to domestic miners. The program is expected to launch in Q2 2026 with initial purchases beginning in March. That gives shorts less than 30 days to decide. Cover now at $87 or wait and hope the policy fails. But if the government is serious and Project Vault moves forward, waiting could be catastrophic. So why is this happening now? Let's look at the bigger picture. In 2024, China accumulated over 800 tons of gold and an estimated 15,000 tons of silver. Russia, India, and Saudi Arabia have been stockpiling metals for years. The dollar's share of global reserves has fallen from 72% in 2000 to 58% in 2025. Central banks are preparing for a multipolar currency system, and hard assets, gold, silver, copper, are the foundation. Trump's administration knows this. Project Vault isn't just about countering China. It's about positioning the U.S. for a world where commodities back currency credibility. If the dollar is going to compete with a gold-backed yuan or a commodity-linked BRICS currency, America needs its own strategic reserves. And silver, unlike gold, is both a monetary metal and an industrial metal. It's used in solar panels, electronics, defense systems, and batteries. If you control silver, you control the energy transition. Here's the leaked part. According to a memo obtained by Reuters, the Trump administration discussed a strategic mineral stockpile as early as December 2024, before the election. The plan was to wait until after inauguration, crash the metals markets through coordinated margin hikes, and then announce the stockpile and price floors at the bottom. That way, the government buys cheap, taxpayers don't riot, and domestic miners get guaranteed support. It's brilliant and ruthless. Let's play this out. Assume the government sets a floor at $90. Assume Project Vault buys 500 million ounces over the next 12 months. That's $45 billion at $90, well within the $12 billion headline, plus additional congressional appropriations. Assume global mine supply remains flat at 800 million ounces per year, and industrial demand stays at 600 million ounces. That leaves 200 million ounces for investment demand. But now add this. If China accelerates its own stockpiling, if India continues buying at premiums, if solar panel production ramps up in 2026 as planned, and if retail investors in the West start buying again after the crash, total demand could hit 1 billion ounces. That's a 200 million ounce deficit. In a deficit market, prices rise until demand is destroyed or supply increases. But supply can't increase fast enough. New mines take 7 to 10 years to develop. So what price destroys investment demand while keeping industrial demand alive? Probably $150, $200. At $200, some industrial users switch to alternatives. But until then, the market has to clear. And if the government is the marginal buyer, guaranteeing a floor at $90, the downside risk is gone. That's when speculators, hedge funds, and sovereign wealth funds pile in. And that's when 200 plus becomes possible. Let me bring this full circle. If you're short silver right now, here's your nightmare scenario. The government announces floor enforcement in March. COMEX inventories continue to drain. They're already down 15% since January. Physical premiums stay elevated at $15, $30 over spot. Then, in April or May, a major industrial buyer, Tesla, Apple, a solar manufacturer, announces it can't source enough silver at current prices and is willing to pay $120 for guaranteed delivery. Suddenly, the paper price at $90 is irrelevant. Physical trades at $120. Your short position, mark to market, is underwater by $30, $45 per ounce. Now multiply that by 50 million ounces. That's a $1.5 to $2.25 billion loss. And the only way out is to buy physical or buy futures to cover. But if everyone does that at once, the price doesn't go to 120. It goes to 150, 180, $200. That's a short squeeze. And with a government-backed floor, there's no escape hatch. The floor guarantees the price can't collapse, so shorts can't wait it out. They either cover now or face infinite risk. So here's where we are on February 5th, 2026. Trump announced a $12 billion mineral stockpile that includes silver. Vance confirmed price floors for critical minerals, likely $8,100. The January 30th crash looks more and more like a coordinated takedown to buy cheap. Physical premiums are $15, $30 over paper spot. Shorts are trapped with a government floor below them and a supply deficit above them. And the math says 200 plus silver is now a realistic scenario by the end of 2026. This isn't speculation. This is policy in motion. I'm not telling you what to do. I'm showing you the data. If you think this is conspiracy theory, go read the Bloomberg article, the Reuters report, the Al Jazeera breakdown. It's all sourced in the description below. The question is, are you going to wait until silver's back at $150 to believe it? Or are you going to act on the evidence in front of you right now?